showtime. So Srikant, I think some of us already know you well, or to some degrees, but just to spend a minute on your journey and background. I was joking with Shahab earlier that it's really hard to come up with a thing that you haven't done. I saw that you've even been a consultant at McKinsey at some point, and so we'd love to just get the journey voiceover and then dig in further after that.
Sure. So I was born and grew up in India, and so I went to college there, got a degree in electrical engineering, came here to the US to get a business degree, and since then I'd say my career has broadly gone in three broad chapters. First one I call, looking back, I think of it as my profit without purpose chapter, where started out, as you said, first as a management consultant, then as part of a large corporate's investment team, and then continued in the corporate world, but as an entrepreneur. So it was where I co-founded and led two venture-backed tech startups and helped grow and sell them. And then switched to what I would call the purpose without profit stage, where I went to Seattle, moved to Seattle, and joined the Bill and Melinda Gates Foundation, where my role was to build out a portfolio that was essentially focused on using technology to improve the lives of smallholder farmers in Africa and Asia, and then left them to become a founding president of a nonprofit college focused on challenges faced by first-generation college students here in the US, low-income students and students of color. And that's what we got started, and what I led in its initial years is now Mount St. Mary's University Online. So that's sort of the purpose without profit. More recently is the chapter around profit with purpose, where I've really been on a quest to figure out how to use the power of technology and capitalism to more meaningfully impact some of our larger social and environmental challenges. We're focused on climate change and inequality. And my initial sort of attempt at going there was join Techstars as a partner on the investment team, where I was responsible for looking at the subset of Techstars companies that had an impact dimension to them. And this was across Techstars 50-odd accelerators. That's where sort of formulated the vision behind what we're doing now, which is Avesta Fund, where we saw some gaps not only faced by Techstars companies, but also across the sector, which sort of where the idea for Avesta was born. So I left them a couple of years ago to launch this fund. So that's sort of brings us back all the way to today now.
As I was expecting, I think you are too humble and skip over decades of different types of cool things that you've done. One thing that I was noticing as looking at your sort of set of experience was, it's not just, by the way, I love that framework with profit without purpose, purpose without profit, and purpose with profit, or profit with purpose. But it's not just between the nonprofit and the for-profit sectors that you've moved. You've also sort of straddled, operational roles and investor roles. You've also straddled sort of some more, advising versus being a founder yourself. And so were those cross currents parallel to your moves between the sort of for-profit and nonprofit sector? Did they correlate, or were they sort of ancillary to those main moves that you just mentioned?
Well, I guess, yeah. I mean, in each of those, it's almost like I've been in both an advisory or an operational role, and an investment and operational role in both the non and for-profit sectors. Mm-hmm. So I guess, I mean, if I were to tease out, we could look at the nonprofit world versus the for-profit. I mean, I was fortunate to have worked at arguably one of the larger, or the largest private foundations out there, backed by the Gates family and Warren Buffett's money. And so it was a great experience to learn firsthand sort of what made some nonprofits successful and effective versus not. And I guess at a very high level, if I were to look back at that experience, I'd say I've taken away, not that this is the only thing to take away. For me, I felt like there's two broad ways to be effective in nonprofits. One is you can do something really close to home, small scale, get dirt under your fingernails, where you're working directly with people that you're helping. And it's a very fulfilling sort of, I mean, I've been a big brother, big sister volunteer, and I've done some things very close by, and that's a very different experience, but it makes a real difference in someone's life, and you can see that. But then the other way is a very sort of somewhat more intellectual exercise where you're looking to make large scale systemic change. There, I think, I found lots of foundations as well as nonprofits get caught up in a self-fulfilling cycle where it just ends up being, if you're a grantee, then you always go back to the grantor. If you're a grantor, you get used to writing checks year after year. I've sort of grown a little bit more, how should I say, hardcore about it, saying for that kind of broad systemic change, I think it's useful to think about the theory of change that you're setting out to do before you may jump into something, where the best use of philanthropy and nonprofits in that regard is as risk capital, which can ultimately catalyze and crowd in investments from, you know, either the markets or the government. Because at the end of the day, even as I mentioned, even the largest philanthropy is still a drop in the bucket, which is partly what drove me to say, well, how do you harness the power of capitalism? Because it's either capitalism or the governments where the real big dollars are, which can have an impact on systemic change. And in order to enable that, I think philanthropy has a very useful role to play if it is viewed as risk capital to help figure out what are the market failures, what are the reasons why government is not able to act here, and therefore how does our money in a finite period of time help unlock some of those failures in order to crowd in and catalyze either the market or the government. Because ultimately that's where philanthropic risk capital can best be able to sort of land a new entity. So that's sort of at a high level, some experiences with the nonprofit world, where otherwise I think you can have impact, but it's hard to scale and sustain that impact in some ways.
Definitely. I think that's just so relevant for sort of a student crowd that is sort of brimming with energy to, you know, address some of these challenges, be it climate or inequality, which I know you work on at Avesta. And, you know, often the main question is, okay, exactly to your point, I want to do this. What's the right landing spot? Is it government where there's a huge lever, but it moves really slow? Is it philanthropy where there's, you know, good intention, low scale, but really a lot of purpose? Or you know, commercial sort of for-profit sector where, you know, it's a mix of both of those things. I guess one way I want to frame it to you is, let's say I'm a student working on a deep science or deep tech problem, and I have some vision for it. You've probably advised dozens of, you know, this type of profile. How would I think about the advantages or disadvantages of, you know, pursuing, for example, government grants or philanthropic capital to sort of drive my work versus going out and seeking sort of pre-seed money from a VC? How would you think about sort of that, you know, given that you've sort of seen it all?
I don't know about seen it all, but let me try to take a crack at that. And are you saying specifically for deep tech kind of solutions or more broadly?
Yeah, like a technology answer to some of these societal challenges, be it in healthcare, be it in climate, be it in, you know, any other area of large scale challenge. Got it.
Well, I think if you're going to go down the VC route, it's probably helpful to understand how and I know you know this intimately, but for the sake of the audience, I'd say it's helpful to understand the VC's business model, which by and large, with some exceptions, they tend to be a 10-year business cycle where a VC, say a VC like us, right? We are the general partners. We go raise money from limited partners. And our business model is to promise a certain amount of return as well as a certain time frame. So we are promising to return our investors' money with the profits within 10 years. And I think that's helpful for a founder to understand that, saying, okay, the investor that I'm seeking, they may not tell you this explicitly, but they're certainly thinking about sort of what is the time to liquidity. If I invest in this startup, in this company, can I see my way to liquidity within 5 to 7 years? Because if not, then even if I love the founder, love the idea, love everything, If I'm an investor who is basically running a VC firm, in order to do right by my investors, I would have to say no, because it's not an appropriate VC investment. So I think the reason that I bring that up is beyond the typical questions that any VC raises in terms of what's their team, what's the product market fit, what's their unfair advantage in go to market, et cetera. In the case of some hard tech, hard science ones, there is this whole sort of technology readiness level. So you can traverse from TR1 to TRL9, or said another way, from your bench scale to prototype to pilot to scale deployments. And it's useful to think about what is the stage at which I can legitimately look a VC in the eye and say, I can promise a return within 5 to 7 years. If not, and that can happen either because you get bought or you go public or some other way, right? But that is their business model. So you have to respect, if you're going to take their money, how you achieve their goals with that. With that said, with that background, I'd say it's useful to think about that. And oftentimes, especially the hard tech ones with hardware components, et cetera, the key differences between that and a regular software-based SaaS company, if you will, is the time to market and the capital intensity. And there, if you think your product has multiple stages between the TRL1 to say 5 or 6 or 7, by which time you can find an appropriate VC investor, it's useful to figure out other sources of money. And yes, I mean, grants may look like free money because it's, it doesn't come at the cost of dilution, but there is no such thing as a free lunch. At the end of the day, you have to spend time. It's not easy. You need to get some savvy advice who knows how to work through the whole, funding cycles and what they're looking for, et cetera. But having said that, I think it's important, it's useful as a mechanism to get some of those early technology risks and early sort of prototyping risks off the table in order to then be able to deliver that sort of 5 to 7 year return cycle. Because if not, then it's probably better for both for you and for the VC not to be taking their money. But having said that, then I think if you can get to the point where you can de-risk some of those early elements, because I mean, often VCs joke about, is this ready for the market, or is this going to be a lab experiment for the next 5 years? And if it's the latter, much as we may love the team and the experiment, it's probably not a good VC investment in the 10 years. There are literally a handful of exceptions which go with 15-year life cycles or what have you, but those tend to be the exceptions, not the rule.
That's right. And, I see in my seat people trying to experiment with those types of fund structures or compensation structures for the, venture capitalists themselves. And to your point, it's really a handful and hopefully growing with these experiments, but it is a slowly changing landscape. Maybe that's a good segue into sort of your thesis for creating the Avesta Fund and sort of what compelled you to create that pool of capital there, given what you just mentioned about sort of the advantages and the constraints of that model for solving some of these longer term problems.
Sure. I guess one way to, I use the profit without purpose, et cetera, kind of framing. Another way to think about this is between my partner and I, we both have had, 20 plus years each of lived experience in the worlds of regular tech startups and the VC world and the impact investing world. And we firmly believe that those two worlds have something of value to offer each other. But we also have seen, for too many reasons, and there's some real nuance, but real reasons why those two worlds don't really know how to walk in each other's shoes. And that's especially challenging when you get to that very early stage, the pre-seed and seed stage. And that's where we saw the opportunity to say, hey, we've worn some hats in the past. And I've shared my background just to sort of walk you through my partner Stuart Davidson background. He was a successful venture capitalist. He handled several $100 million and did very well as a GP of that fund, Labrador Ventures. But then over the last 20 years, he too has been on this sort of quest to figure out how to use that VC mindset towards an impact goal. So he was the first investor in what became Acumen Fund, still chairs their investment committee. He had the Skoll family with their philanthropy, and then they transitioned to impact investing as a member of their investment committee, was part of the Rockefeller Philanthropy Advisors investment committee, helped Impact Assets and Tonic and Gears all get started. He was part of the founding teams of several of those in various fiduciary as well as advisory roles. So it's all a way of saying he too has lived those two worlds. And we realized that we have some value to add to be able to say to a founder, hey, we understand the challenges you're facing about meeting payroll and growing and talking to VCs, et cetera. We also know that you started this company not just to make money, which is great, we love that, but we also know that you want to make a difference and make the world better in some tangible way. And as you probably found, it's easier said than done. There's a lot of language issues. You may say I'm an impact company, but someone else who's listening may think completely different what you mean. Because unlike something like an IRR or NPV, those words mean different things based on who's using them. And there's a lot of missed connections in this space when you're trying to straddle those two worlds, which is sort of why we say we come in and our goal, basically back to this idea of being a better bridge between the impact and the tech world, we think we have some opportunity to really bring those together. Specifically, we have something we call seed impact investing at scale. So the seed investing at scale is a model that I saw firsthand at Techstars. I also happen to know that there is a handful of other companies like Y Combinator and 500 Startups and AngelList and Techstars. Those happen to be 4 of the leaders in seed investing at scale, who have grown from no money under management to over 5 billion across those entities themselves in just 15 years. And they've proven a model of investing at the seed scale, which convinced me certainly that it's fundamentally a different asset class than regular venture capital. So I think that kind of model of investing needs to be brought to the impact world. So that's sort of one reason we got into this. And then there's another whole idea around impact at scale. How do you help these founders figure out their impact in more than just the sort of superficial sense, but to really sort of understand where is the impact in their business? How is it really integrated into their business model? How do you then help them sort of make that real in a way that you both culturally you bake impact into their culture from day one, but also help them communicate this in accountable ways through their KPIs and dashboard and their stakeholder communications, so that if you do that right, then you can start to help them grow their impact as they grow their business. And if we do our part right, then we're enabling a number of these companies to get started with the right from the outset, with the right impact orientation, which we think has a long, I like to say, culture has a long half-life. It's the first few people that you hire, the culture you form with them, the way you talk to them, that outlives you in many ways. So if we can really make impact fundamental to how you run your business from day one, that has the potential, we have to prove this, that has the potential to have a long sort of half-life and ensure that you protect against mission creep and some of the other challenges you naturally face. And that's sort of our intention at growing this, to say, how do we use our experience in the regular tech world and in the impact world, try to engage at that very early stage, at the pre-seed and seed stage, help them get off on the right foot, and then open doors when they're ready for the Series A for other like-minded investors. So our theory of change is basically you get them going at that early stage, help them figure that out, then help hand off the baton to other like-minded investors who join their cap table when it's Series A. Then that momentum has built from day one, and those folks will continue to help with that momentum over time. That's what we're trying to achieve with this.
Great. And do you think that sort of ecosystem is built out in terms of the follow-on investors? The reason I ask is I'm curious, if you look at the current landscape and the current set of sort of founders that you come across, what do what you see as some of the chief risks to their, I would call it mission creep, what you're describing as this idea of sustaining that impact culture? Is it, how much of it is the hiring of the team? How much of it is, the set of investors around the table at the seed stage? How much of it is the fact, the idea of having someone like Srikant around the table at every stage? And sort of how you see those levers, given you've seen these Techstars company go.
Yeah, it's a great question. And actually that is sort of when the coin dropped for me. I'll give you two sort of stories, if you will. One was, at Techstars, given my role, I had exposure to the entire sort of database of 5,000 financings across 2,500 companies across 15 years. And I was able to slice and dice it in many different ways, and saw that over the last 12, 13 years, about 12, 13 years ago, about 1 in 6 companies in Techstars had a strong impact along one of the UN SDGs. But more recently, it's just under 30%. So 27, 28% of the companies are impact. So if you just take that as a data point, the proportion of companies that Techstars is finding and investing in because they have the potential to make money is doubled in just about 12 years in terms of, or almost doubled in terms of the impact subset of it, right? So that was one point. The other thing was I noticed when I looked at the actual financial returns of those, that the impact subset outperformed the overall superset. So that was sort of when I was like, wow, okay, this is interesting. There's a lot of impact companies coming and they're doing well. And then it's like, who's investing in them? And when I did that analysis, I found that less than 5% of the companies investing in these, of the funds investing in these impact companies at the stage that we are involved in, for instance, were impact oriented. So in other words, there were all these companies being founded by impact-oriented entrepreneurs who clearly wanted to make money, but also wanted to make a real difference. But they found that their money that was actually coming, I don't mean the friends and family, the institutional kind of money was more traditional Sandhill Road kind of VCs. And that's the disconnect we're aiming to solve. And I think part of the reason is, it's back to my, okay, there's the language problem of you say impact and they hear, you say tomato, they hear tomato, or what have you. There's this connection impedance mismatch. The other reason is oftentimes a lot of the impact dollars are held by family offices and high net worth individuals, et cetera, who have a natural reticence to be found very easily. So it's actually in there, unlike the Sandhill Roads, you know exactly how to reach them. They have almost a preference to not be reached until they want to reach you. So it's almost sort of a hard bridge to span. So that's sort of one challenge, if you will. The other story I wanted to share was, you folks are in the Bay Area, so this will resonate, and I live in Denver. And I remember 2 trips I took to San Francisco airport, where literally within about 6 weeks of each other, I remember one was to a tech conference. So I landed in SFO and took the south on 101 and went down to Silicon Valley and went to this conference with 15,000-20,000 people, all the technorati, if you will. And then a couple of months later, I went to SOCAP, which is like one of the leading impact investing conferences. There I turned right after getting off the freeway and went north to the Mission area. And I found another huge group of folks who were all about impact and so on. And then I looked around and I could probably count in a handful of names of people that I would have seen in the other conference. And I'm thinking to myself, wow, these are 2 very rich ecosystems. I happen to be going to both of these, but it's almost no overlap between the 2. And that's sort of where I felt like, hey, there's an opportunity to really sort of help find a way to get these worlds to live in each other's shoes more effectively. I don't know if I answered your question. I was just sort of got into the story.
No, you did. One piece that came up for me when you were, those stats from Techstars are very interesting and compelling, and just make me happy that you've gone through that and sort of proved the case that impact often actually means financial outperformance. I'm curious how you sort of dealt with the question of intentionality in that type of analysis and how you deal with it now. There's impactful products that will move the needle, but maybe the founders are not impact oriented or don't like framing it in those terms. And the opposite is also true. So how do you navigate that for Avesta, and how did you think about that question at Techstars?
At Techstars, what we did, in order to classify a company as impact, with a small team, which is a centralized team, we took a first crack at saying, let us look at each of these. Literally for 2,500 companies, we went and looked at their product and said, can we legitimately see that this aligns with one or more of of the UN SDGs, just the product itself? So we were looking for primary impact, not secondary impact in terms of how they ran their companies or what have you. It was like, could the product be such that as the company grew, the impact would grow? That was what we were looking for. I admit that's not the only way to define, but which is how we defined it at that time. And then we validated it by sending each of those companies to the managing director who ran the accelerator affiliated with that company to say, this is what we're thinking for your companies. Do we have it right? Would you reclassify any of these and tell us why and why not? So that's how we came up with the list of impact subset. That's what we did there. In terms of what we learned since there and since, I would say we are less looking for someone who can speak the impact language, because there are a lot of people, in some ways, there's almost sort of the danger of greenwashing with someone who's really well versed in the language, but hasn't got the true motivation around it. So we're willing to give people a pass on the language and the frameworks, et cetera, because we know that, and we can share our lessons there and get you up to speed. What we're trying to, obviously it's a judgment call, but what we're really trying to do is to say, do you really care about this? Is this important to you? And why is it important? Let's try to understand. Because if it's important to you, we think we can help with the rest of it, you know. And I mean, just to use a story, I remember watching Sir Alex Ferguson, you may or may not know, was the long-term manager of the Manchester United team back in its heyday. I remember an interview of his once, and where the interviewer asked him, so what do you look for? Because they were also known at that time for having brought up players from the teens, etc. What do you look for? And he said, I look for the kids who want the ball. Everything else I can teach, but I can't teach them to want the ball. And not to put ourselves anywhere in the same zip code as Alex Ferguson, but the point I'm getting at is, the skills you can teach, the frameworks you can teach, but the motivation's hard. It's got to come from within.
I had not heard that about Alex Ferguson. That's I'm going to use that. I'm going to steal that from you. I'm conscious that we've been now speaking for about 30 minutes. Maybe I'll pause here, open it up to those of us who are here this evening. I have more questions and can go back to them, but want to just open it up a little bit, since I think we've covered quite a bit of ground in the last 20-30 minutes. Anyone have any questions?
I can ask a question.
Go for it.
Sure. Thank you so much, Srikant. It's so inspiring and interesting to learn about your overall thesis and the opportunity. I wanted to learn more about some of the challenges that impact investors face. You spoke about the challenge around technology de-risking and the business model of impact investors wanting an exit and some form of liquidity in 5 to 7 years. How the business model of impact investors is evolving to be different from mainstream investor. Is it really the same now? Like, you just look at founders who want to focus their companies on ESGs, but you still on the sustainable development goals, but you still want that 5 to 7 year exit, and you still want, I don't know, 30x, 20x return, or is it more modest, or is it more patient? I'm thinking about, especially this desire of founders to keep their company's mission driven. Sometimes it prevents them from selling, so they need to continue owning and governing their companies. So what does it mean then for some return for the investor? So many questions in one, but basic is like how the business model can also evolve to be more impact driven.
Yeah, no, it's a great question. I would say, I think it's important to keep in mind that venture-backed firms as a total, right, is about give or take 1 or 2% of all the companies started in America, right? So it's a small, admittedly, they end up being responsible for some of the most growth, both in terms of number of employees and in terms of market capitalization, et cetera. But in terms of sheer numbers of companies, there are far, far more companies that never get venture money than there are who do. And I think that is a reflection of the fact that not all companies are right for venture. So I think it's important to understand sort of what is the right return profile and scale profile that you and your company wants to have if you're going to go to raise money from venture capitalists. I think, Mohammad, you asked the question of how do you look for? I answered from the perspective of VC, but having said that, it's not the only perspective that counts. So there's, as you know, there's various ways of financing. So, but the challenge is that I will be also open about. I've always wanted to see more happen in terms of in entities that are willing to take concessionary rates, if you will. Just to put specific numbers on this, if you think about a large foundation which has a philanthropic mission, usually they're taking about 5% of their endowment and giving it away in grants, where the effective return is minus 100%, because every dollar you spend, nothing comes back to you. So the return is minus 100%. And then their entire corpus, they're usually investing in market rate returns, where if you're talking about early stage companies, they're looking at risk adjusted market rate returns, you know, and the 20+% IRRs is what they're even closer to 30+% that they're aiming for, which is where that leads to venture money. And for what it's worth, there are some exceptions as well, but I would love to see more capital move to the point where they say, you know what, if we're willing to give away all of 100%, can we live with some more modest return expectations? So I hear where your question's coming from. In fact, I've explored that myself and at some stages in my life to say how much can we go? But unfortunately, I think what I've concluded is that tends to be the exception, not the rule, where I think people find it easy to say, I understand how the risk-adjusted market rate return works. I understand how to evaluate fund managers in that regard. So I can figure that out. I understand how to give away money and not expect anything. I don't
get tax benefits out of it.
Yeah, and yeah, there is that tax benefit aspect, but I don't understand how to handle, like if someone came to me with a risk-adjusted market rate return of 3%, hey, I'll still get my money back, and theoretically, you can keep putting that money back to work. I just haven't seen that happen in any scale. And Mohammad, you have a pretty good bird's eye view. I'm curious whether you agree with that, based on your experience, or, you know, and clearly, I mean, there are exceptions to that rule for sure.
Yeah, I mean, it's a perennial question. I would say just maybe a tidbit of additional thought to Nargis's question. I think where I see, as I was mentioning earlier, where I see sort of evolutions in the VC model in the impact space is more around compensation structures and sort of fund terms. So, you know, to this problem of I need liquidity in 5 years or 7 years, you know, folks are trying to elongate their fund lives, such that, you know, the investor or the limited partner going in sort of does not expect that. It doesn't necessarily change the return profile of the fund. It just changes the sort of timing of when you get paid, right? So you still might have the same IRR. And then secondly, and I think more interestingly, and perhaps, you know, with a little bit more adoption, is things around, you know, how do I get paid as the venture capitalist, as a fund manager? And am I tying my carry or my compensation to the achievement of certain impact goals that I define upfront? And that sort of has a dual mechanism. It kind of takes care of this first problem a little bit too, because if you're at year 5 and you can exit and you get a financial payout, but you don't achieve your impact goals because it's too early for that company's impact to be achieved by that exit, you know, it incentivizes the manager of the fund to sort of balance those, right? And say, okay, do I want to maybe wait a little bit and, you know, don't force an exit here because I want to make sure that impact is achieved and that unlocks a portion of my carry that I really would like. But it's, you know, what I've seen so far is not material enough to really dramatically change those decisions. It is in the experimentation phase and getting the LP community, I think, more comfortable with these innovative types of compensation structures.
Yeah, no, that's fair. We have done the same thing. We have put some of our carry at risk based on our achieving some impact goals. But having said that, I agree with you. We're also at that experimental. It's a small portion of the total carry, but it's a way to send a signal that we care about it. And
then on the concessionary part, it's tricky for me. One reason it's tricky is because, you know, what we've seen in, for example, microfinance in emerging frontier markets is sort of a flood of concessionary capital going in. And when you provide concessionary capital into the market, you risk distorting some of those market dynamics and you risk creating dependencies on that concessionary capital. So if that's not the true market rate, then once your capital dries up, let's say your foundation changes strategy and your endowment is no longer doing concessionary investing, you kind of leave that market in a pretty vulnerable position. But that's only if you're providing, that's, you know, if you're a fund, you can have a concessionary return to your LPs that's not necessarily commensurate with providing concessionary capital into the market.
Yeah.
And so the cool solutions or interesting solutions I've seen is when you use concessionary providers to de-risk capital, or de-risk the investment for folks that are maybe not interested in concessionary returns.
Yeah.
And that's when you sort of stack, your capital structure in an innovative way. And a lot of work has been done, and some of it is really interesting around social impact bonds. That sort of use this mechanism, and even in for-profit equity investing, we've seen some of that.
Yeah, no, I think there have been some really good, like the pay for success models, which are well there. And I think given that some of your audience are in the healthcare space, I certainly saw that play out really well at the Bill and Melinda Gates Foundation, because they were quite put forward on making these advanced market commitments to essentially create a market for things that didn't exist. So there were certain kinds of vaccines for, malaria. No one was putting money into this, but they set out certain terms under which they would effectively buy a bunch of vaccines if they hit certain performance benchmarks, and that created a market for something which otherwise wouldn't have existed. That kind of thing certainly helped with the AIDS vaccine in the early days and the Gavi.
Yeah, even in the, that's Gates has been pretty cutting edge on some of that early on, from a nonprofit sector. But when you look at the carbon credits market today, the same sort of action in terms of creating these advanced pledges and markets is happening from folks like Stripe and Microsoft. It's not, it's not a nonprofit pool that's making using these same strategies.
Yeah, no, exactly. And we all know the cost curve, how you need to get beyond a certain amount of volume to ride the cost curve down. And yeah, no one's going to pay, if you are on Microsoft, like $300 a ton or $400 a ton, but that's sort of where you have some of the more interesting approaches. And the idea being, if you do that and do it at enough scale, at some point it'll get to $60, $70, and then you start to clear the market, etc.
Yeah, it could turn out to be a perfect example of, you can actually make a lot of money if you commit early and sort of do the right thing, quote unquote.
And that's the kind of risk capital I was referring to too.
Yeah.
I mean, what I was saying about philanthropy also exists for this kind of concessionary rate. I think that comes back to the theory of change around saying, if you do this now, is there a reason to believe, either because they'll write down the cost curve, or because you're creating a market it didn't exist, or because you're taking some risk off the table by first loss guarantees or pay for success for other players to then take the risk, if you will, etc.
Anyone else with any other questions? If not, I'd maybe like to get a little bit more tactical, Srikant, for, again, an audience of students that are thinking about purposeful entrepreneurship. Let's say I'm thinking about founding a venture focused on these challenges that we've been talking about. Where would I begin? The well-beaten path of a venture that does not have is not addressing these societal challenges, is not impact oriented, is well known, right? Like, I would apply for YC, I would apply for Techstars, I would go to Sand Hill Road, I would do the song and dance. What, if anything, would you tell your founder community to do differently, and how do I start sort of landscaping the potential investors?
So in terms of where to go for money,
where to go for money, where to go for support, some of this thought partnership that you are now providing in Avesta, in terms of let me guide you on how you hire the team that sort of sustains impact. But how do I navigate that whole ecosystem?
Yeah, no, I would say I'm quite impressed by. So part of the reason we started our fund and focused on the pre-seed and seed stage is we actually think there's a lot of incubators and accelerators. I mean, that stage, which is one stage even before us, right? There's a lot of them out there, and they don't seem to stop coming. And every day we learn about new ones. I've been in this space for a while, but you still hear about new ones. So I actually think there's a pretty vibrant community of accelerators which are worth looking at, because I think the good ones. And the only thing I'd say there is it's important to know and do some diligence around who they are and what kind of portfolio companies they've had in the past, what kind of experience and success they've had, etc. But having said that, yes, there is some value in separating the wheat from the chaff, but that's a very good place to start. And not all of them take equity. In fact, several of them in the impact space are happy to do this with either nominal or no cost, if you will. And so there are examples of that, whether it's in the climate space or in the inequality or in the health space. There's a number of them there. I would start there for sure. And the point about getting some of these SBIR grants, there's phase 1, phase 2, there's government grants. I know you folks are sitting in California. California has had a huge budget surplus in its recent state budget year, and they're starting to put a lot of that money to work in early stage research funding and so on. So I do think there's some opportunities for grant funding. It doesn't come free, as I said, in terms of the time, but those are definite places to go into. Probably, I mean, those are in terms of tactically where to go in some ways at a high level, but I think I would be remiss if I didn't say this, given the market we're living under these days, is that having been through the original dot-com boom and bust and then the 08, 09 financial crisis, I would suggest to founders, I think both those times I found that founders underestimated the rapidity with which investor sentiment changes. I mean, so we've been around a stage where there was so much money chasing deals and founders learned to get a bit sort of happy with themselves. And that environment's changed, as you know, from the investor standpoint, and founders are going to feel that the next 6 months and 12 months are going to be like nothing they've seen before, because the vast majority of founders who are in college now or grad school or what have you have never faced some of those earlier boom and bust cycles. So it's useful to remember that cash is king. We used to have a saying up at Techstars, drink when served. So if you're able to raise money, even if you may not like the terms, especially at times of market turmoil like this, I would make sure that you have enough to last a couple of years in terms of funding, because it's you don't know when the market will settle down enough that investors will start to loosen their purse strings. It's best to assume they won't for a while.
Certainly, what I'm seeing, and it's a little bit, some of it is quite sobering. You brought this point up a few minutes ago, and I want to follow up on it because it's related to what you just said, given the funding environment these days, in terms of other forms of financing, right? The fact that only 1 or 2% of businesses created in the US are venture-backed. Where do you typically tend to sort of point people towards? Is it, oh, this may be not a venture-backed business, maybe go pursue a revenue-based financing type structure, or is it, maybe try to bootstrap for a while, wait out until this wave passes, or, to our earlier conversation, maybe this is something where you can get California grant money, and then go raise. How do you think about sequencing some of those different available capital tools?
Yeah, I would say, especially if you're starting out, excuse me, in a university context, sorry. I mean, if you're in a clean tech, for instance, you could go to Empower Innovation or the SBIR. I mean, SBIR is the US federal government, and that comes in a variety of areas, not just clean tech, a number of areas. That would be a place. I think there's also opengrants.io. That's another place where you can look at sort of grant funding opportunities. I believe California itself has several opportunities. I'm not as fully up to speed on all the exact sort of, but I think there's certainly several of them there. I live in Colorado. There's several Colorado state funded opportunities for grants, etc. So I think that's probably the first phase, especially if you're at that sort of bench scale or sort of prototyping kind of phase. We come back to this idea of, unless you find a venture fund which is on a 15-year life cycle. There are a couple of them now which are coming up, things like Prime Coalition in the clean tech space. I don't know, Nargis probably knows way better than me about health tech, if there are similar funds there with a longer life cycle. But those would be probably my first suggestion, rather than a traditional venture, until you have some sense for being able to say in such and such time. I'm not suggesting that you have to have it fully ready to go, but I think they need to be able to see that you're starting to turn that corner, that inflection point towards getting some market feedback on your technology.
One idea that I was thinking about, just hearing your talk about this gap in the market of people who are willing to invest in these type of companies that can take a longer time to exit or have a different return, but it's not philanthropy. They still can make money out of it. But it seems, we, for some reason, we don't have enough investors who are interested in exploring that model at this point. And I was thinking the corporate world, because a lot of companies do have goals now around sustainability, around equity, both their more foundation side, like the CSRs, but as well as just their usual, their mainstream business, as well as maybe government. So I'm thinking, like, how can we get some big sources of capital and resources that haven't been traditionally working very closely with startups? I remember when I was working at Roche, we always had this discussion that Roche gets too late. They get involved too late. Like, they buy companies for hundreds of millions of dollars, but if they were involved earlier, they could have saved a lot of money in maybe acquiring some of these businesses, as well as they could provide so much strategic advice and mentorship to these startups. So I think there's that part of a market that it requires building a network between these corporates that share goals, and then channel that resource and capital towards very early stage innovation, which is not really happening at the scale that we need to see happen.
No, I fully agree. I think it makes a lot of sense for corporates to be involved. However, I would say, I think back to some experience at Techstars that I was privy to, and I know you have some connections with Plug and Play and those kinds of players, right? I mean, what I found is, you're exactly right. They tend to vote with their feet a bit later stage. And I think it's because of this impedance mismatch again, where the companies are used to dealing with many more zeros in their balance sheet, and for it to be meaningful enough to do the diligence in order to make an investment, it's almost not worth their while to make $100,000 or $500,000 or $1 million investment, because the sort of egg on your face, if it goes down, which often it can, is worth more in terms of cost to the person putting their name behind the deal. So it ends up being much more risk averse than you'd like to see. So what I've seen, in other words, it's not all gloom and doom, in the sense that I saw it work well at Techstars, where they created a nice line of business for them, and I see Plug and Play doing the same. I know there's other entities where they become the middleman, if you will, where they say, we'll take money from a number of corporates and create an environment where we'll be the source of capital for those very early stage, but we'll also be the source of innovation and ideas for these corporates, and we'll help them figure out how to plug in the form of proof of concepts and pilots, etc. I've seen it work effectively with a middleman. I've seen it work less effectively with the corporates. They say the right things, but they don't know how to act in a way that is consistent with the speed and decision-making cycles that you require at a seed stage startup, if you will.
Yes.
It's the exception to the rule. Yeah.
It's interesting, as you were talking, I was thinking of what Mark Carney, the former governor of the Bank of England, used to call the tragedy of the horizons when he was talking about the climate challenge.
Yep.
But we see that so much, especially in the corporate world, for all the criticism we have of the VC model, of that forced sort of 5 to 7 year, 10-year liquidity. There is a sense of job security for the principals involved that is aligned with the time horizons. And you would think these large corporates would benefit from that same dynamic, but in many cases, it's actually a less secure position for the individuals involved, to your point, Srikant, where I might not be around to see the sort of evolution of this investment. And to your point, the egg on your face moment is a little bit more detrimental than a VC making a bet that fails, which is sort of part of the model and part of the expectation.
Yeah.
So some of this stuff becomes office politics
Yeah.
in a non-productive way. I want to do another pause and make sure, I know we have a couple of new people in the room here, but if there are any questions, and I have one last question I can shoot to you, Srikant, but I just want to open it up for a bit. Great, I'll shoot my last shot. The background you have and the sort of story coming from Techstars into this model is pretty compelling. And I'm again thinking about students thinking about purposeful entrepreneurship as a journey. There's a lot of advice out there, lessons for entrepreneurs in general, and some of it is like, yeah, we know that, we've heard that. I'm curious, when you talk to impact-oriented founders, either in the context of your work today or at Techstars, what are some things they wish they knew earlier? Or what are some things that you wish they knew earlier as they navigate this sometimes pretty difficult journey?
Well, that's a tough one. Let me see if I can. I'd say a couple of things. I mean, one, even those overnight successes that everyone reads about in the papers took 20 years to make. I mean, most people, it's the very, very rare exception where there's a straight up and to the right kind of curve in the life of a company. So there's a lot of ups and downs in these things. So be ready for that. Be ready to take your lumps, because you'll be handed a lot of lumps in this process, and find a way to come back up. Because I think that resilience is a key driver of longer term success, and there'll be a lot of hits one takes in this game. I think that's probably the other thing, especially when you deal with folks who are close to the technology, they have tremendous intellectual horsepower and tremendous depth in a certain area, is to start with the customer and the problem, the use case, and not lead with the solution or the technology, where it's obvious that you need the depth in the technology to be able to figure out a way to bring it to market. But I think it's still helpful to always keep the customer and the use case in front and center, to say, who's going to hire you, quote unquote, hire you, and why? What's their job to be done? And in that instance, is it, I mean, the cliche about vitamins versus painkillers is, there's the one common thread is around falling in love with your technology and assuming, man, this has to be in the world. Why doesn't it exist? It's great, but unless you are solving a real problem for a real customer, it's unlikely to see the sort of take that you need to see, first of all. Second, if it's a vitamin where it's great, it's good for you, it's eat your broccoli kind of stuff, versus it's really I can't get out of bed because I have this migraine and I need this painkiller in order to get out of bed and go to work. If it's a painkiller, it's more likely to see someone willing to put their name on a new entity to say, yeah, I need you to come and help me solve this. Because, vitamins tend to get set aside, especially when you have this kind of market turmoil conditions. People are focused on the job that is staring them in the face. And I think I used to say this back when I was in a CEO position, that, unless we have a CXO with a title that has some real power, and you're under the top 2 or 3 or 4 of their priorities for the year, you're not going to see the traction as a startup. Some CXO needs to find some real value in their problem. Otherwise, it becomes a vitamin. It's easy to set aside. They may still talk to you, but they may never get to the point where they make the final sort of leap. And that's a challenging place to be, especially when you come from a technology forward kind of place. I don't know if that addresses the question you were asking, but some of the common themes I've seen in terms of some early challenges.
No, I mean, the painkiller versus vitamin analogy is apt, especially in a ecosystem here where we're trying to really address large pains. And, I think what I'm hearing from you is focus on most effective, most needed solutions that actually have demand, and the rest will almost come.
Yeah, I mean, and you see this all the time in climate solutions, right? I mean, I think Bill Gates calls it the green premium, where I think it's entirely great that we're all like, climate warriors and we want to go make the world better. And it's great. We may want to make changes in our lives because we think it's the right way. But for it to reach some scale, you have to still appeal to someone sort of Excel spreadsheet sort of way of looking at the world, saying, okay, is this cheaper? Is it better? Is it faster? Is it more convenient? If it's not, I'm going to wish you success, but I'm not going to fundamentally change my behavior, because it's just, I mean, I know I wake up in the morning thinking I should be a better me, but I still have a job to do and I have a family to feed, etc. And that ends up becoming one of those things where it's very hard to berate a person into making a change. You have to appeal to their self-interest in some way.
What a great sentence to potentially wrap on here. Unless Nagus or anyone else from the emergence team or any of the audience here has anything else to add, I just want to say thank you, Srikant, especially given that the plague caught you this week. We're grateful that you made the time and you brought all your energy here. And I learned a lot from this conversation, and I hope it'll be useful to others sort of thinking about this career journey.
No, thank you for the opportunity. I enjoyed the discussion as well. It's wonderful to bat this around with like-minded folks who are all trying to row in the same direction. So I appreciate the time and wish you all the best. And if I can be of any help, please let me know.
Likewise.
Take care.
Thank you, everybody.
Thanks very much, everyone. Thank you so much. We'll be in touch.
Thank you, everyone.
Thank you. Bye.